Why do fluctuations in oil prices impact Iraq's exchange rate so dramatically? This question is crucial for understanding the broader economic landscape of the country. Let's dive into the economic mechanics behind it. The relationship between oil prices and Iraq's economy is intricate and multifaceted, involving various economic principles and policies. Iraq's economy is deeply intertwined with oil production. In fact, oil accounts for more than 90% of the country's exports and a significant portion of its GDP. This heavy reliance on a single commodity makes the economy particularly vulnerable to price swings in the global oil market. When oil prices dip, Iraq's export revenues take a hit. This reduction in revenue can have a cascading effect on various sectors of the economy, from public services to private investments. This means less income for the government, leading to budget deficits and potential debt distress. The government may find it challenging to fund essential services, infrastructure projects, and social programs, which can further strain the economy. But how does this affect the exchange rate? The exchange rate is a reflection of the country's economic health and investor confidence. When oil revenues decline, the value of the Iraqi dinar can be adversely affected. As oil revenues dwindle, the government's fiscal policy becomes crucial. Policymakers must make difficult decisions to balance the budget, often resorting to borrowing or cutting expenditures. To stimulate growth, fiscal expansions may occur, but this can lead to increased government debt. Higher debt levels can erode investor confidence, making it more expensive for the government to borrow money. Consequently, the country's creditworthiness can take a hit, raising borrowing costs and weakening the currency. A lower credit rating can deter foreign investment, exacerbating the economic challenges. Monetary policy also plays a significant role. The central bank has tools at its disposal to manage the currency and stabilize the economy. The central bank can intervene in the foreign exchange market to stabilize the currency. This might involve using foreign reserves to buy or sell the dinar, or adjusting interest rates to influence capital flows. In Iraq, decisions like interest rate adjustments influence the demand for the Iraqi dinar, affecting returns on investments denominated in the local currency. Higher interest rates can attract foreign capital, supporting the dinar, while lower rates can have the opposite effect. But it's not just oil prices that drive exchange rate movements. Other factors such as political stability, economic reforms, and global market trends also play a role. Investor sentiment, economic fundamentals, and global financial conditions all come into play. For instance, geopolitical tensions in the region can lead to risk aversion, causing investors to pull out their capital. When oil prices fall and investors perceive increased risk, capital outflows can occur, putting downward pressure on the exchange rate. This can create a vicious cycle where a weaker currency further undermines investor confidence. In summary, the nexus between oil prices and exchange rates in Iraq is complex. It involves a delicate balance of fiscal and monetary policies, investor sentiment, and external economic conditions. While oil prices directly impact Iraq's fiscal health, exchange rate movements are also shaped by monetary policy, fiscal policy, and broader economic conditions. Policymakers must navigate these challenges carefully to maintain economic stability. Understanding these dynamics is crucial for policymakers aiming to stabilize the economy amidst volatile oil markets. By implementing sound economic policies and maintaining investor confidence, Iraq can better weather the storms of fluctuating oil prices. Ultimately, the goal is to create a more resilient economy that can thrive even when oil prices are low. Diversifying the economy, investing in other sectors, and improving governance are key steps in this direction. Education and innovation can also play a significant role in reducing the country's dependence on oil. By fostering a skilled workforce and encouraging entrepreneurship, Iraq can build a more sustainable economic future. Exploring alternative energy sources and revitalizing agriculture can provide new revenue streams and reduce the economic impact of oil price volatility. These efforts can help create a more balanced and robust economy. Strengthening international trade relationships and attracting foreign investment are also vital. By integrating more deeply into the global economy, Iraq can mitigate some of the risks associated with oil dependency. In the end, the well-being of Iraqi citizens depends on a stable and prosperous economy. By addressing the challenges posed by fluctuating oil prices, Iraq can pave the way for a brighter future for its people. The journey may be challenging, But with strategic planning and resilient policies, Iraq can overcome the hurdles and achieve long-term economic stability and growth.